Welcome to another episode of Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I am joined by Tim Sustak, our SVP Chief Treasury Officer, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. Scott, what do you expect to hear at the upcoming Fed meeting? And would you mind just giving us a brief economic outlook?
Yeah, sure. The upcoming Fed meeting, we'll start off there. Really don't expect a whole lot of changes. Between meetings and at the last meeting, the Fed basically let us know that they're on hold, and they're going to be on hold for a while, and they're going to follow the data. So since their last meeting, the data has given them no reason to not remain on hold. If anything, it's given them more reason to to continue to sit tight, keep rates where they're at today, and see what happens. So, the unemployment, there's a lot of, I guess we should start off too by saying there was a lot of concern heading in, and this is why the Fed is on hold, is because of the impact of tariffs, right? Really not knowing how tariffs were going to impact the economy, how they were going to impact inflation, how tariffs were going to impact the employment situation. Would companies have to lay off people because of tariffs? Because people, the thought was that maybe we stopped spending as much money in different things. So far, we haven't seen any real impacts from tariffs on either inflation or employment. That's the good news. Now, part of that could be because tariffs were, I think the announcement came in March, and then quickly a lot of these tariffs were rolled back or lowered as we're in negotiations with different countries. To date, we've only reached an agreement with one country, the United Kingdom. We're still, working on agreements with the European Union and other Asian countries. So more agreements likely to come in principle. Although we talk about these agreements, they take months to actually iron out all, and maybe years to iron out all the specific details because they get very granular. But they can agree to a framework, and that's what we have with the United Kingdom. So far, these tariffs that have been put in place haven't really impacted the economy. So we've continued to see inflation fall, which is getting closer and closer to the Fed's 2% target. So we're seeing this with consumer price index. We're seeing this with the PCE, which is the Fed's preferred inflation measure. Both have been trending lower. But with that said, we're still early in this, and we could certainly still see an uptick. When you look at projections over the next month or two for inflation by economists and by Wall Street, they anticipate that inflation will start ticking higher. So that's something we're on the lookout for, is do we see that filter through to the actual readings, right? So sentiment has been very negative. Consumers have been thinking that inflation is going to be higher when they do surveys, in some cases substantially higher, but we have not seen that. So what this means at the next Fed meeting is the Fed's likely to remain on hold. We're going to get a new SEP from the Fed. Their projections going forward, we're going to get a new dots plot at this next meeting. So we'll see if their projections change at all, but very likely I would anticipate that we're going to see the Fed's thinking will be, yes, we'll probably have more rate cuts this year. I would say 1 to 2 rate cuts is what the most likely scenario is. And although they're not going to give us the month that they're going to do that, they do it by year when they do their dots plot. More than likely, we'll see those cuts if they come later in the year. But the Fed is going to be on hold for at least this meeting. More than very strong possibility they're going to be on hold at the July meeting, and there's a good chance they could even be on hold in September.
Okay.
But September is probably the most likely month that if they do have to start cutting rates, that'll be when it is, because we will have seen some of that data that maybe is starting to deteriorate. But really, thus far, I would say the economy has held up much better than people thought it might when the tariffs were announced. And really coming into this year, there was some concern of maybe some slowdown. We saw in the first quarter where we had negative 0.2% GDP.
Mm-hmm.
So GDP fell 0.2%. So that was worrying. But when you factor in the fact that really what drove the negative GDP print was, tariffs. Companies were importing a bunch of materials and products before tariffs hit. So it really skewed the balance, the import export balances there. So we had a lot of imports that came in the first quarter, and they hadn't had time to work themselves into the economy and into inventories and into sales and things like that. So that negative 0.2% first quarter GDP was really artificial. It wasn't really a normal functioning economy because of the tariffs. It's starting to work its way out, and to the point now where when you look at the Atlanta Fed does their GDP now estimates for the second quarter. When I looked at it a couple of days ago, they were projecting over a 4% second quarter GDP. So that negative print we saw in the first quarter should turn into a very strong second quarter of GDP. So we have strong growth. Consumers are still spending. This is something that I've talked about a lot here recently. And when I give presentations or when I'm just talking to people about what they're seeing, asking them what they're seeing, and we're still seeing people spending, right? Restaurants are still really full, and it almost doesn't matter what day of the week you go. People are they're finding money to spend. Airplanes, when I've been on planes, recently, they're still very full. Maybe not to capacity, but I've gotten lucky on a recent flight where I had an empty middle seat. I felt special because I could actually stretch out a little bit. But yeah, there's people are still spending money. Now there are reports that people are saying they're going to cut down on summer vacations, that they're not going to spend as much money this year on summer vacations. So we'll have to see what that data looks like. But what I'll say so far is when you look at sentiment numbers, when they survey people and ask them how they're feeling, those have been very negative here as of the last, let's say, 3 or 4 months, very negative since tariffs were announced. But it still has not translated to the economy yet, to the actual numbers. We still have not seen that slowdown in spending. Um, Internally, we have a credit group, and they take a look at some of the investments we have in credit card asset-backed securities and auto asset-backed securities. And first quarter we were seeing some negative trends there carrying over from last year, but they've somewhat improved here recently, where people's credit card balances have come down, and we've seen delinquency slow down a little bit. So now that could be driven by income tax refunds. People maybe are saying, okay, I'm going to take the money this year and do the smart financial thing, pay down debt and be responsible. And that's possibly what's happening. It could be temporary, but so far everything still looks good. Now, with that said, I'm still looking for signs of, this sentiment transferring over to the actual hard data. It hasn't happened yet. And historically, there's not a real strong correlation between the two, between what people think and what they actually are doing. But the concern is that at some point it may happen. So the economy is still chugging along pretty well. The latest unemployment rate was held steady at 4.2%. So still not giving the Fed any reason where they might want to move and start. If the unemployment started to deteriorate and climb, say we got to 4.4, 4.5%, then the Fed might say, hey, it's time to start, especially with inflation coming down. It might be time to start lowering rates again, but we're not seeing that. So things are just kind of holding steady, not giving the Fed a whole lot of ammunition to start saying, hey, we really have to move or the economy is going to suffer. So they're likely to be on hold for at least the next couple of meetings and maybe a little bit longer. My projections this year, we'll see what Tim, if he agrees, but I think we'll see 1 to 2 rate cuts this year at the most. And honestly, I think you could make the case that the Fed stays on hold for all of 2025. But we have a president who wants the Fed to cut. We have a Fed who has a bias towards cutting. But they're being patient about it. So we very well could see a cut or two this year still, backloaded, end of the year type of thing, barring something, one of these black swan type of events that we get occasionally. But right now, things are really, despite negative sentiment, things are just plugging along. When you looked at the latest employment data too, on an annual basis, wages are up 3.9%. So nothing crazy, but they're still holding out pretty steady. That was expected to drop this last month in May, and it didn't. So it held steady at 3.9. The unemployment rate again held steady at 4.2%. We created 139,000 jobs, which is is down from last month, but still higher than what was anticipated. So the employment situation is still looking good. We are seeing a little bit of an uptick in unemployment claims, but it's still not a worrying sign. And then continuing claims, the same thing, slight uptick, but nothing that is in that really worrying stage right now. So I think overall, with the employment situation looking strong, consumers still spending, and inflation currently heading toward the Fed's target, still heading lower, we're in that really positive place for the Fed to just continue to wait and see. And then again, we expect a strong GDP in the second quarter. So, if President Trump comes out and reinstates some of these tariffs again or raises them, then that could change the whole trajectory again. But right now, I don't want to say we're in a perfect economy right now, but we're kind of floating along and still doing okay. And consumers, again, are still spending money. So the summer will be telling. Okay. But so far, I think things are pretty positive.
All right. Thank you. So, Tim, do you agree with what Scott said? And would you also mind providing, a liquidity update as far as, what you're seeing and hearing?
Yeah, absolutely, Jamie. Thanks. Scott and I usually see things pretty similarly, and this is still the case. I mean, I agree with what Scott said. I just can't imagine, given, what we've been seeing with the economy, that the Fed does anything except sit and watch and wait for a while. And they've told us that's what they were going to do, to Scott's point. So I think there's no reason not to believe them. And, you look at the recent economic data that's come out, and it's just, you get a couple good pieces, you get a couple less good pieces. And then, we got the jobs numbers today. Those were a little better than expected. ADP released their jobs report a few days ago. That looked a little bit worse. You just don't know. To Scott's point, things are just kind of ambling along here, and everybody's waiting for this big shock from tariffs that hasn't come. So I agree. Fed's going to sit back and watch. I think that's all they can do. They tell us all the time that one piece of data does not make a trend, and they're not going to act on that. So I think they're going to need to see something definitive in, the realms of, a quarter's worth of data that establishes some sort of trend before they're going to act. Absent some catastrophic event, obviously they'd have, then they'd have to act and deal with that. But I can't imagine that they're going to do anything except sit and wait for a while. And I agree with Scott. I mean, if we got one or two decreases this year, that would be, that would be great. But I'm certainly not betting a lot of money on that one way or the other, I guess. So, I think the same thing liquidity wise. It's kind of an interesting situation here, to say the least. And Scott, please jump in if you have anything to add from credit unions that you're talking to. But I'll start with the corporate. I mean, the corporate liquidity is very, very strong, and particularly has been for some time now, and particularly for this time of year, right? I mean, we've got almost $6 billion in average for May in deposits, and it was dropped a couple $100 million. I think we're a little better than 5.8 on average for May. But that a couple $100 million drop is lighter than what we normally see this time of year. Certainly follows trend. We do start to see a decline this type of year, and actually May is usually a pretty sizable decline. So decline was certainly not what we're used to seeing, which is good. We've got about 3.6 billion in average in Fed accounts. So really strong access to cash liquidity. So no liquidity concerns at the corporate. And, generally, I think that's the way it is in credit union land in general. I mean, you have your outliers here and there, but, the stories we're hearing, credit unions certainly have seen deposits come in. Those deposits are staying. Some credit unions are struggling a little more to make loans with higher rates, but other credit unions will say, hey, I really don't have any problem making loans. I can make them if I want to. But deposits are still coming in, and the question is where are they coming from? From a corporate's point of view, we thought a couple things. Number one, since we were in that liquidity strain a few years back, credit unions certainly became at one point more judicious on what they were doing with their liquidity, trying to rebuild cash stores. So we thought, well, some of that could be, ending up here. But you talk with credit unions, and it's coming from the consumer. And to Scott's point, the restaurants are full, the flights are full, so people are spending. But you look, the savings rate is ticking up. And, the soft data, like Scott had mentioned, consumer sentiment has not been great. So you can certainly see why people would be socking some money away if they have it available, to plan for this rainy day that everybody sees coming that hasn't shown up yet. So, like I say, right now, liquidity very strong. There's always outliers, but, credit unions should know we certainly have liquidity, and we stand ready to help any credit unions out there that have a liquidity issue if you're having some liquidity problems. So please, contact us. We'll be happy to help, and we've got funds to give. So right now, thankfully, can report that liquidity for most is not a problem, and that's great because there certainly was some stress a few years back. So it's great to not have to, with all the things we have to worry about right now, it's great not to have to worry about liquidity. So.
Well, you guys have been telling me the same things for the past couple months. We're in a wait and see, Jamie. That's what you keep telling me. So I kind of expected the same report today. But before we go, any final thoughts for our listeners? Scott, any final thoughts?
Yeah, I mean, I think continue to listen to the Fed. We say this every meeting or every time we have this discussion. But yeah, listen to the Fed. We'll see what they have to say at their meeting next week. But again, we anticipate it's going to be the same old thing. As Tim reiterated, they're just going to sit and wait and hold for a little bit. There's no reason not to. I liked what Tim said. It's we're all kind of been waiting for this rainy day looking out of the window, and it's not coming. We anticipate it. We've anticipated it. We're hearing all about it, but it hasn't come yet. And it's a little surprising, I would say, in one sense, but it doesn't mean it's not coming. Maybe there's some kind of delay there. So if we continue to watch the data, and it's the stuff that we talked about earlier, look at the jobless claims that come out on Thursday every week, and then look at the employment numbers that come out once a month on the first Friday of the month, and then those couple inflation indicators, PCE and CPI are huge indicators of what give you an idea what the Fed is thinking and what they'll do. And as Tim said, I agree. They're going to look for a trend. If we see 1 month of something looking negative, they're not going to make a jump right away. They're going to sit there and wait. So, I think the one thing that is a little bit of concerning for some folks is just the higher interest rates we've seen, right? Because there's been a lot of concern in the markets, and this is globally, not just in the U.S., but the level of debt that the U.S., Japan, Germany, and other countries across the globe have. It's led to higher government bond rates in those countries. It's been a little bit of a knockoff effect. So there's a little bit of stress there, and it's certainly not helping the housing market for credit unions, unless they're doing HELOCs. And the HELOCs, my understanding is there's been some pretty good activity in home equity lines, because people have low mortgages, they want to stay in their homes, but they want to make it more of the home they want it to be, right? So they're spending money to upgrade and renovate. But just tagging on with Tim, based on that, the higher rates and stuff, liquidity is probably going to, I would imagine, to hold pretty steady here. We see a normal summer runoff, obviously, with the seasonality there. But yeah, just listen to the Fed and follow those few economic indicators. And, credit unions obviously have the insight, too, of seeing what the consumers are doing on savings and borrowing. So.
Yeah. Well, you mentioned there the housing market a little bit, and I'm just going to make a comment. This week alone, I've gotten 3 letters from 3 different realtors asking me if I wanted to sell my home. So it's amazing. But I'm like, why would I sell my home based on the rates now to go buy one?
Exactly. It's a really slow market. And there's a lot of people in your position that, if you have a sub 4% mortgage rate, what's your incentive to move? I mean, it's really hard to get people to sell those homes unless they have to for some reason, move them for a job or something. Yeah.
Tim, any final thoughts for our listeners today?
Yeah, I guess a couple to jump on the housing talk. We had folks that sold a home 3 doors up from us recently, and the word on the street is they got 120 better than asking price. So that shows you what's out there. Both of the points you made, homes are in demand, and I don't know, that's hearsay, but there's usually some truth in that. So I suspect they did pretty well. But But to kind of piggyback on what Scott said, I agree. You have to follow the Fed. They're the ones that are going to make the decision. Listen to what they say. And I think back, we had a really great presentation, I thought anyway, at our risk conference. The gentleman that had a journalist background and was just talking about the media and how to interpret things. And his talk was centered around if you're everybody has their political bent and sentiments and things like that. He said, but look, if you're going to listen to all the talking heads out there, in all honesty, you have to listen to both sides, right? Because everybody's going to spin it the way they want to spin it. Both sides are going to spin it. And if you're going to listen to the talking heads, you have to at least listen to some of what the other side has to say, because the real truth, what probably is going to happen, is probably somewhere in the middle of those two. So I would say, yeah, definitely follow Scott's advice with listening to the Fed. And if you can't do that, if you're going to listen to talking heads, at least try and listen to both sides a little bit, and then, piece together what you think is going to happen, because I think honestly it's anybody's guess at this point. So.
All right. Well, thank you. Thank you both so much for joining me today. I really appreciate it. This episode of Financial Minds is brought to you by Vizo Financial's Financial Conference. Breathtaking views, powerful insights, credit union connection. The height of financial education awaits for you at Vizo Financial's 2025 Financial Conference. Vizo Financial's premier financial event of the year will take place on September 10th through the 12th, 2025 at the iconic Omni Grove Park Inn in Asheville, North Carolina. Get ready to soar as we dive into today's most pressing financial topics: interest rate, loan performance strategy, economic and regulatory updates, investment and bond opportunities, and more, as that are led by expert speakers from Bloomberg, Wells Fargo, and other top-tier institutions. The 2025 Financial Conference is your summit for financial education built exclusively for credit unions. Registration is open, so visit Vizo Financial's website at www.vfccu.org today. Thanks for listening, and make it a great day.